That's my motto. All right, we finished 7-1. That quiz was due on Friday. We're now down to 7-2, and we talked about mix and yield variances. We can go over more questions like that. So let's talk about overhead variances. We'll talk over them real quick and then try some problems. Then we make sure we have, between today and Wednesday, we'll make sure we have full coverage of our 7-2 variances. So one thing real quick to point out is, the very stereotypical variances of direct material and direct labor are common in a lot of businesses, especially manufacturing businesses, of course, because they have more direct materials and direct labor. Although service businesses often have a lot of types of direct labor. Many of you would go into service businesses. You'll go into service businesses like an audit firm, and direct labor is tracked there. It's tracking your billable hours. And you can do variances based on that. And so I'm glad we covered that and reviewed that with you. We talked about how, for some of you, we knew how we got it into the journal entries and got the general ledger itself to do some of the accounting for us. So we can tease out some of those variance numbers just by looking at different accounts and how they move. And then we also made sure that we went over the fundamental principles that brought us to the direct materials and direct labor variances that we use. The idea of isolating one variable we're moving from budgeted to actual. One lever we're pulling is always the visual I'm trying to portray here with my hand. And then the idea of that being a meaningful distinction. So not only is it one budgeted versus favorable, but that's one of the building blocks, it's one of the standards you have for why you would budget a number or whatever the number is, direct materials cost, for example, or direct labor cost, for example, because I want to make sure we have those underlying ideas so that we can adapt to more unique or different variances that are out there. A company's going to use some of the stereotypical ones. Oh, here's our direct materials variance. Great. It might also use some that are specific to the company. I went over a bit of that. An example of like a trucking company. Here's what we might consider for our trucking company. Some number that's important to us about time on the road. And there are various subcomponents that make up that. We could then tease out variances that would help us manage that performance over time. The variances this week have a certain flavor to them like that, where we're taking, okay, we have our quantity variance. We're going to pull it apart now because we have various substitutable inputs into the quantity variance. We want a mix variance, and what's left over becomes the yield variance, which has its own special rules. But a lot of the rules of thumb here end up being the same. A lot of them. And with overhead variance as well. Now I have a big I have a disclaimer, contextual note 7.6.1 in front of the overhead variances. And I still, I wrote that a number of years ago, but I still consider it to be relatively accurate. I'll just summarize it to you in case you haven't, gone through and read it and committed it to memory for you. In my opinion, my personal opinion, I find the overhead variances to be slightly less valuable than the direct materials or direct labor variances, or some of the custom ones you might come up with. Because overhead responsibility is already a bit of a fiction. Something doesn't become overhead unless we cannot economically, feasibly trace it to product units. So we are already allocating it based on a lot of assumptions. The idea that there's a cost driver, like a job order costing, yet there's some sort of cost driver that approximates the relationship between some activity, but that approximates the responsibility of individual product units or individual jobs or individual orders for the overhead costs. And then we're going to go ahead and take variances off of that. It can be a signal. It can be a signal that you use to improve responsibility, but also understand you're at risk of creating this house of cards of assumptions. And so because overhead already has one layer of assumptions, you build on the variance assumptions on top of that, you are now 2 layers deep into assumptions, at least here. So I consider them to be slightly, at least, less useful than the direct materials and direct labor variances, because you still have the possibility of the slippery snakes, slippery fish, or whatever, people slipping out of responsibility because they can hide behind those overhead assumptions, or you can make incorrect adjustments because actually that variance was largely due to some incorrect overhead assumption we made because it's overhead, not because of some mismanagement of the overhead. So they can be useful signals, but I consider them less useful on a relative scale than other variances. All right, so variable overhead is going to work a lot like our direct labor variances. In fact, if you use direct labor hours as your driver, you end up with some very, very comparable equations. So variable overhead, it works like our I'll say direct labor. It works like our direct labor and direct materials variances in a lot of ways, but let's focus on direct labor. It's the cleaner of the two. The idea is we have a quantity variance and a price variance. So those are familiar, right? And they operate as you would expect. We have actual quantity minus budgeted quantity or standard quantity times a rate, a price. Now, price is the predetermined variable overhead rate. So if we're using job order costing and we have, we'll put it in the spreadsheet just to keep it. Let's say we have budgeted 20,000 overhead and we budget 2,000 cost driver units for the period. We're going to have a PDOH rate of budgeted overhead over budgeted cost driver, right? $10 is our PDOH rate. Great. Here's the thing. This budgeted overhead is going to be between some variable overhead costs. It's going to be a sum of variable overhead costs, budgeted variable overhead costs, and budgeted fixed overhead costs. Let's say it's 15. Let's turn on unblock first of all. 15,000 budgeted variable overhead costs, and 5,000 of that is fixed overhead costs. So let's now make that into a sum of those two. And so it's the same idea here. What we're trying to do is we're trying to tease out the variable portion of this PDOH. And so what we're going to do is we can just simply take the variable portion over our cost driver, which is what it says here. So the predetermined variable overhead, that is let's go back a second. We have our PDOH rate, includes variable and fixed. We're going to variable overhead cost per unit of the cost driver. Yeah, so we have, as a result of that, we have variable costs, budget variable costs over budget units of the cost driver, and that should be our PDVOH. Problems will typically give you this or have some way that you can feasibly calculate it. They'll say something like, here's the PDOH rate, 75% of that is variable costs, which is exactly the numbers right here. And so you say, 75% variable proportion of PDOH. Okay, well, that PDOH rate times 75%, we end up with the PDVOH. Right, so that's our kind of our cost of variable overhead. Like if we're buying them from a third party. We aren't. They're internal to us as a company, but we're going to put them in the calculations as if we're buying them from some third party, or rather, you can conceptualize it as if you're buying them from some third party, as if you're just paying an employee, paying some vendor for material. This is price. So the PDVOH is the standard price. So we have AQ minus SQ, the difference of those times a standard price. So here it is written out all the way. Here it is algebraically rearranged. Just the two equations are the same, just rearranged in case you're worried about that. It's one equation, just rearranged differently. AQ is actual quantity of the cost driver used. So if you remember, we end up allocating overhead by multiplying that PDOH rate by the actual cost driver consumed. So we had 100 orders this month, and they actually consumed, let's say they actually consumed 2,200 hours of whatever, or units of whatever the actual cost driver, whatever the cost driver is. So we have our budgeted cost driver units and our actual cost driver units. This is SQ, this is AQ, and this is SP. And so in this little example, we can take our AQ minus our SQ and multiply them by our standard price, SP. And so that would be our variable overhead quantity variance. Okay, it's positive. We're going to forget the yield rules. The yield flipping and everything, all the weird stuff with yield is just for yield. We can go back to the rules we learned for 7-1 about signs and what's favorable and unfavorable. This is an unfavorable variance, right? We used more cost driver units than we expected to use. I also spotted a typo. I'm going to write that down. Okay, price variance, looking very similar. It's going to look very similar to what we saw with, say, direct labor, direct materials, just with slightly different terminology. So we have still AQ. Let's just use that. We still use the same AQ right here. The difference in the parentheses is going to be this SP right here, subtracted away from AP, actual price of variable overhead. So the idea is we actually incurred a certain amount of variable overhead cost. We budgeted $15,000. Actual total variable overhead costs, let's say it was $14,000. So we're gonna, that's our actual variable overhead costs, and we can divide that by 2,000. And so this should be our actual VOH right here. So now we can take, and that's AP. So per unit of cost driver, we actually used $7 instead of $7.5. So we have in here now actual, put in the parentheses, actual price minus the standard price, all of that times the actual quantity. So this is should be our variable overhead price variance. Unless I'm mixed up somewhere, which is possible. This should be a favorable variance. We paid fewer dollars per unit of cost driver than we expected. Again, assuming as if this is with all these assumptions we make about cost drivers and responsibility for overhead costs being enforced, we're acting as if those assumptions are for sure and valid. We have our two variable overhead balances here, and the sum of these should nicely equal, this is the sum of VOH variances, should equal the difference between what we actually budgeted for overhead and for variable overhead and what we what we budgeted for it now. Why is it not? We'll come back to that. I'll come back to that in a second. All right, so talk about how it means. Let's see. The quantity variance reflects the variance due to how much cost driver the firm used. Now, it could be that this is mismanagement. It could be that we just had a misunderstanding of how much the cost driver really is related to our overhead consumption. Again, there's an assumption in effect there. The price reflects the dollar to cost driver relationship between the cost driver and variable overhead costs. All right, so the idea is that an unfavorable price suggests we paid more for our variable overhead than expected. Again, we made assumptions that are in addition to the typical assumptions related to price that might be at play here. Those questions will be pretty straightforward. We'll go through them and check on them. I want to kind of leave it right there for variable overhead and talk about fixed overhead, because this is a little bit of a different animal. So this mountain chain looks a little different than the mountain chain we're used to, and have three different squares at the bottom here that we're subtracting. And most of the fixed overhead cost questions focus on you being able to just identify those squares. It's much less about the equations, because we don't focus on an algebraically rearranged version of these. These two are next to each other. I get it. It looks like these two being next to each other and these two being next to each other, like, oh, they must be the same equation. No, these are the two equations for the two fixed overhead variances. There are 2 or 3 different ways I've seen in textbooks of doing fixed overhead variances. You can have a 3 variance model, a 4 variance model. What I'm teaching you here matches up with a 4 variance model, basically. The 2 variable overhead variances and 2 fixed overhead variances. That's 4 variances. All right, so the idea here is that we shouldn't have a quantity variance for fixed overhead, because fixed is in the name. Fixed with relation to volume. We really shouldn't have the same variances we have with fixed overhead that we have with other ones, because we're not really ramping up our fixed costs with volume, with the quantity of this input used. Now we're using extra square footage of the factory in most cases, and so our fixed factory overhead lease cost, which is part of our fixed overhead costs, It's not like that's going to be ramping up or down. And so let me just literally visually contrast it here. We have our typical mountain chain way up. Oh, there it is. We have our three variances and two that we focus on, the quantity and the price variance. And with the fixed overhead, we're going to get rid of this quasi-budget and take flexible budget. We're going to get rid of both of these. We have actuals, static budget, and we have another one over here, which is applied costs. Let's go down way over here. And so we have, actual fixed overhead costs, and how much we budget for fixed overhead costs, because they shouldn't vary. They're fixed overhead costs. They should be the same. Any variance in that itself deserves an explanation that's separate, and we don't have to worry about changes in volume and price. Something has happened there that we can almost always trace down pretty directly. Fixed overhead costs are supposed to be pretty fixed, and when they change, we can probably hunt that down pretty easily. Here, this is to reflect the fact that what's on the books is a fiction due to the way we allocate costs, overhead costs specifically. Right? We are. Let's just get into our Chapter 4 mindset. Basically, we're assuming we're in a Chapter 4 setting of job order costing, and when I explain it, at least, and it fits with 5 and 6, but the easiest way to understand it is in Chapter 4. And we have what we budgeted, and we're going to, based on the volume of what we produced, and therefore the volume of cost driver, apply a certain amount of costs. So we might end up applying more fixed overhead costs than we actually even budgeted, much less than we actually spend. We might budget more or less of our applied costs. And so the standard quantity we're using here is the quantity of cost driver, the quantity of that we're applying to our overhead, to our inventory accounts, because we've consumed so much cost driver, higher or lower than expected. And so this volume variance right here is different than the volume variances way up. It's volume due to the fiction of overhead cost allocation. It's a useful fiction, but it still is ultimately a fiction. So if our spending variance, I'll start with that. Let's talk about that first. It's just literally actual fixed overhead costs, minus the static budget fixed overhead costs. And perhaps I don't think I have a question that does it. I might have a question still that makes you multiply these out. But we have two things moving here. It's not very scientific, but we can be not very scientific again because this is typically easy to track down why this variance would have occurred. We renegotiate our lease. That's why our static budget doesn't match our actuals. Okay, well, that's pretty easy to assign responsibility ownership. Over here, we have held budgeted price constant, and we have simply said, well, the budgeted quantity of cost driver here versus the quantity of cost driver right over here. I put it over to the right to keep our signs the same. So static budget minus applied cost is going to have the right signage to favorability based on keeping them in that order, basically. Having did I say that right? I know last term I changed this textbook to fix a problem. I've got to make sure I'm saying it the right way. The way I'd like to say it by instinct, and I'm trying to recall. Because I've written it out here differently. I've written out actual cost driver, which is what the budgeted star here is supposed to represent. It should be, I just write actual quantity in the figure here, minus the static budget. So I've written it out, applied minus static on this equation right here. I wonder if I meant to fix this equation and I did not. Well, we're going to get a chance to test it out on some problems in just a second. The instinct I have is to say that the static budget actually is less fictitious than the applied cost, because the applied cost takes the static budget and then multiplies it by cost driver consumption that may or may not be associated with things. So we might have, let's say we just have one fixed overhead cost, that's building lease. So we have a static budget. We expect to lease for 12 months. We have a budget price of $1,000 a month, so $12,000 is our static budget expectation for building lease. Well, we take that $12,000, we divide it by, let's say it's 12,000 cost driver units, so it's $1 fixed overhead per cost driver unit. but we actually consume our actual quantity, which again, this is, I think I will over the next day or two fix this section again if I haven't already. If I assuming I did it before when I meant to do it, and make this into actual quantity. But we're multiplying this. Let's say we actually consumed, instead of 12,000 units, we consumed 13,000 units. And so our applied cost was actually $13,000 of lease. There's no reason for that. There's no reason because we consumed 13,000 cost driver to expect us to have $1,000 more of lease. That's less informed than when we sat down and said, well, this is our lease. Literally, here's the contract, and this is the amount. That's more informed by actuality than we applied based on some fiction that, well, with every with every unit of cost driver, $1 of fixed overhead is consumed. So that's why I have it over here. And I think the problem is indeed I need to flip this equation back. Let's check. Watching the twisted machinations of my brain in real time. I'm sorry for your loss here. So let's jump past the mix and yield questions, which are the first 5 questions, I think, of the 7-2 quiz. And let's look for some of the fixed and variable overhead costs. Let's just look at kind of what these things look like. So notice here, you have 3 big numbers in the big block of text here, the 3 sentences, the first paragraph here. And I'm asking for the fixed overhead, volume, variance. So I'm literally saying, well, you need to subtract 2 of these numbers. You have 3. Subtract the right 2, and determine favorability. So I'm going to go off of my instinct, which is to say that applied cost is more fictitious than static budget. And so if static budget is higher than applied cost, we move closer to reality. Costs went up, so I'm going to consider unfavorable. I know it's going to be, I'm going to base off of the diagram. I'm going with the diagram instead of my equation here because they conflict. I'm going to take 1.5 million as our static budget, and subtract away 1.47 million in fixed overhead costs, because that's our applied overhead costs. So those are the 2 we should be subtracting. Definitely these 2. It's a question of the favorability, because again, I've positioned this one to the left-hand side and applied cost to the right-hand side, and every other diagram, that means you take the one on the left, you put a minus sign and subtract away from it the one on the right. And here I've literally written the equation the opposite way in volume variance. All right, so I'm going to say 30,000, and it goes up when we go from this fictitious applied cost to static budget. So it went up, cost went up. That's unfavorable. I'm going to take that way. 1.5 million minus 1.47 million is 30,000 positive, unfavorable. Let's see if the answer grades it correctly, or the question is graded correctly in Canvas in a minute. We have the same question stem, volume variance here. We have a little bit more in terms of detail what we have to do. So we have a static budget number. So you know what? Let's go ahead and actually write out some of these. Volume variance, and I'll write out the earlier question. This is static budget. This is applied cost for the first question, and I'm taking them and subtracting them. And unfavorable, question mark. All right, so this is FOH volume variance question 2. So we have our static budget of $250,000. Fixed overhead static budget. Fixed overhead costs on the static budget, whatever it is, if you want to phrase it. And then we need to get applied costs. So we have a PDOH of $40 per hour, 75% of which was for variable overhead. So what percentage is for fixed overhead? The remaining 25%. Yeah, good. Okay, so 25% of this $40 is the $10. That should be our fixed overhead, predetermined fixed overhead rate. And our actual cost driver consumption, which is machine hours, which is cost driver's machine hours, it says, was 24,000. So 24,000, actual quantity, meaning actual consumption of machine hours. So we can multiply that, and that should be the amount. That's probably that is the amount we applied. We applied $240,000 of fixed overhead costs. So that should be our variance, volume variance. Subtracting those two from each other right here. Static budget minus applied overhead cost, 10,000 and it's positive. I'm considering it unfavorable as well. So let's go ahead and just before I go any further, test out my thinking, see which of my diagrams is right. Wait, not answer. Oh, I didn't answer the second one. We said unfavorable. I said unfavorable. And we can ignore this one, by the way. When looking at volume variance, we can ignore the actual costs because that's way over here. When we're worried about spending variance, we're just over here worried about static budget and applied cost. So let's test that out. See if we got 5 points or 0 points. Okay, so I coded it in Canvas for sure, like this, the diagram right here. So I'm going to have to make 2 modifications, and I'll try to make those tonight. So by tomorrow, the textbook will be in line with how the questions are. So I need to modify the figure, which means this mountain range right here. So it says actual cost, or excuse me, actual quantity right here instead of budgeted quantity. I think that'll be clearer. That's actually what's happening. So actual quantity. I think in an early version of the textbook, I tried to get away with budgeted quantity and somehow explain how that's. And then I need to update the volume variance equation because it's literally got the. If you have trained your mind to recognize the sign and associate that with favorability, it will give you the opposite of what you need. So I need to rearrange that because it should be static budget, which is this term right here, minus applied cost, which is this term right here. All right, great. Let's look at some variable overhead questions. See how we do. Oh, gotta scroll down. Oh, there's a variable overhead. Quantity variance. Great. We love that one. So a firm applies variable overhead with a standard rate of $150 per direct labor hour. Let's assume there's no fixed overhead for this problem. So this is our PDOH. It's also our PDVOH. Right? I just, with that parentheses, made it so you don't worry about that. Don't worry about trying to split up PDOH into variable and fixed components. The firm's static budget predicted 6,110 finished goods units, and the standard is for 1.5 direct labor hours to be used per finished goods unit. This period's actual finished goods units were 6,500. The firm's actual labor costs were, direct labor hours were 9,500, and actual total variable overhead costs were 1.5 million. All right, so you have a lot of information there, enough to, I think, build a static budget amount for variable overhead costs, how much we should have spent on the static budget, to build a flexible budget based on actual production, to create and to figure out, and you have right here the actual total actual costs. Great. And as a result, also, we have enough to figure out an actual price per unit. We only need some of those, though, because we're doing the quantity variance. So let's go back up here real quick. We're doing the quantity variance. So we just need actual quantity minus budgeted quantity, and the difference of those two multiplied by standard price. So let's write out some of those facts. If it looks confusing to you, start by trying to write out what you can pull out of the question. So I know standard price, PDVOH, because in this case, PDVOH is the same as PDOH. It's all variable overhead, $150. I'm not going to write out specific, that's per direct labor hour. Okay, great. We need that. We also need the actual where are we? Quantity variance, actual quantity of cost driver used, and the budgeted quantity of cost driver used. So let's start with actual. The actual quantity, right here, gives us the actual number of direct labor hours. So that's 9,500 actual quantity. This is of direct labor hours. And we can move these around. There, I think that's a little more clear. $150 per direct labor hour, 9,500 direct labor hours. That's our actual quantity. Now we need our standard quantity. So here's where the professor's trying to trick you, that mean old professor. Static budget 6110 times 1.5 will give you a certain number, probably definitely the wrong one, and it will match the wrong one down here probably. We need to take our actual finished goods production and multiply that by direct labor as our standard quantity for the flexible budget. So we're doing the same thing as we would have done with the direct labor variance. Don't multiply this 1.5 by 6110, multiply this 1.5 by 6,500. So 6,500 times 1.5, that's the direct labor hours we would have expected on the flexible budget. If we knew our actual finished goods production, we would have expected 9,750 direct labor hours. Okay, so we can take, I'll put the parentheses in. We can take actual minus standard, all times our standard price, and we get our variable overhead quantity variance. So it's negative, which should mean favorable. Which makes sense. We can double check. The actual quantity of direct labor hours consumed to produce this 6,500 units, we actually only used 9,500 direct labor hours. We would have expected to use 9,750 direct labor hours. So yeah, we used fewer than expected. So a $37,500 favorable variable overhead variance. Okay, so what does that mean for the firm in actuality? How's it going to use this to improve its business? All right, well, again, we start with the assumption, which is core to overhead allocation, that our cost driver direct labor hours really does assign or is correlated with overhead responsibility. So the more direct labor hours we spend in a given period to produce a certain number, the given number of units, the more we're incurring variable costs. And there's some logic to that. And that makes sense, I think, on a general scale. So for example, we're in a factory and we have variable overhead costs like costs of maintenance of the machinery, costs of like lubricants or shop supplies used to maintain the machinery, various other wear and tear on our tools and equipment. These could be variable costs, and variable overhead costs. We have like supervisor hours as well. It's also a variable overhead cost, or can be, depending on how the supervisor is paid or what their association is. And so if we have fewer direct labor hours, that probably does correlate. Okay, we can accept, at least in some situations, that probably correlates to, indeed, we are using fewer shop supplies because there are fewer direct labor hours being used, fewer people on the floor using that shop equipment, less wear and tear, fewer lubricants going into the machinery to keep it running well. We have less electricity we're using as well. It's another possible variable overhead cost. So I could see that being the case. And so we had a favorable variance. So somehow we used less time, and as a result, we used less of our ephemera there in the factory, our variable overhead cost kind of material in the factory. How do we capitalize on that for the next period? I don't know. It's going to depend on the business a lot. This is one reason why I don't value these overhead variances as much as the other ones. So it's obvious to me to say, oh, well, we need to just work fewer hours. Well, okay, I guess, there are other things that happen with that, more likely to have some offsetting effects when we try to replicate that in the future. But there's the number. So when the firm really wants to know There's your number. Let me fight in favor of overhead variances just for a second. Give me another 30 seconds here to spiel. They can be symptoms of really broad problems, though. So, for example, let's say you have this bad work environment in your company, so you're churning people out really quickly. They might not be very efficient in their time, so they use a lot of direct labor hours. They have instead of a favorable comparison of the actual direct labor hours versus the expected direct labor hours, they are way overspending on direct labor hours to produce the number of goods they are because they're untrained, because they're all new, because you've had to fire a bunch of people or people who quit. It's because it's a bad environment. You could have an unfavorable variable overhead variance that reflects on it, catches some of the dollar cost of having that bad environment. So these are indeed, having a bad company culture. You might think you can't put a price tag on that, and well, maybe not totally, but it does reflect dollar amounts, and variable overhead and direct labor overhead, direct labor variances can both capture some of those systemic larger problems in your business. So you see big overhead variances, don't just wave them away and say, oh, well, my professor doesn't like those, so therefore I'm going to not worry about those. First of all, don't do anything because my professor didn't like it. If I said something that's true, then do something because it's true. If I say something and you disagree with it and you have good reason to, maybe you're even right. Over time, you can see that, oh, you know what? He taught me to do it this way, and I think this is a better way. Good for you. Good. Second of all, I am telling you, you get serious overhead variances that are very large. That probably is a symptom of a really bad problem that might be overflow from some problem in direct materials or direct labor. Okay. So let's talk about let's get a variable overhead price variance if we can, and a fixed overhead spending variance, which are not on this test. So let's go for another draw from the test bank to get those two at the very least. So we have sampled all four of the flavors of our overhead variances on 7-2. Okay, so we have a spending variance right here. And it's in the fashion of our very first fixed overhead problem. So we have our three numbers, our static budget, our applied costs, and our actual cost. If we go down to the figure, we're going to focus on the figure here. Actually, we can use this one. This one I don't think is wrong. No, this equation is spelled out correctly. This one, scratch that one. That's the problem child here. And that line right there with the asterisk, budgeted quantity, I'm going to fix that as well. But these right here, this works just fine. Our actuals minus our static budget should give us our spending variance. And we can just pull those out. Look, our actuals, 117,000, minus our static budget of 125,000 should give us our spending variance. So we can do that in our head even. I want to write it down so we can reference it later. We have 17,000 as our actual fixed overhead cost, and we have 125,000 as our static budget fixed overhead cost. So subtract those two away, and you end up with our fixed overhead spending variance of $8,000. It's negative, so it's a favorable variance. Also, we can double check with the logic. Our actual fixed overhead spending was less than our static budget fixed overhead spending. That's favorable. Yeah, it's favorable. Assuming we got the same amount for less, that's good. Same amount of stuff, same amount of fixed overhead goodness for our firm for less money, $8,000. That's a favorable number. Okay, we have variable overhead price variance now. Good question. This is our last of the four flavors. All right, so we want variable overhead price variance. Let's look real quick at that equation. Just like our more traditional equations, we have a actual price minus standard price, all in parentheses. If we understand what these terms mean, we know this is actual price, this is standard price. The difference of those two times our actual quantity, meaning our actual cost driver used. So we're going to need those three. We're going to need standard price, or rather actual price, standard price, and actual quantity. So let's try and pull those out. All right, let's read through the thing. We apply variable overhead with a standard rate of $5.75 per direct labor hour and no fixed overhead. So that is our PDOH and our PDVOH, which is our standard price. Great. 5.75. We have a static budget amount and standard quantity per unit of direct labor hours, our cost driver. We actually produced this number of units, so we can get a standard quantity if we needed it, but we don't need it. And we have actual total variable costs of 1.75 million. Oh boy, okay, well. All right, total actuals, we know that. And so we know we actually produced 590,000 finished goods. The problem I have is that we don't know how many direct labor hours we spent to produce those goods. We have half an hour as our standard, but that's our standard direct labor hours per finished goods unit. This times this would give us our standard quantity on the flexible budget, but it doesn't tell us how many we actually used. So we don't have an actual quantity. If we had either an actual price or an actual quantity, we could tease out the other one because we know the total of the two when they're multiplied by each other. But we don't have either one. So this could be an actual price of $1, an actual quantity of 1.75 million, or vice versa, just to pull out some random examples, or anything in the middle. So we don't know quite the breakdown of them, of this number into actual price and actual quantity. So the answer is going to be, cannot be determined. I happened upon one of the ones that is one of those got to keep you honest questions. Well, let's jump in and assume if, just so we can do the problem, since we went through all the trouble. If we said, well, actual price was $6. Our actual rate was $6 per hour. Our actual overhead rate per direct labor hour was $6. Well, then we can now take this total actual cost of variable overhead divided by the $6 will give us an actual quantity of 291,666 etc. of direct labor hours, which that's in the ballpark. Yeah, this is about 600,000. That's about 0.5. So it should give us a standard quantity of 300,000 units. Yeah, no, we're not too far out. That's okay. That looks like a reasonable number. So we could then figure out our equation. We take our parentheses, actual price minus standard price, which ends up being 25 cents there in the parentheses, and multiply it by our actual quantity. So that should be our variable overhead price variance, and it is unfavorable. Check the logic there. We paid more per direct labor hour in terms of variable overhead costs than we expected to pay per direct labor hour. So this is what if problem gave us actual price. Okay. Well, 7-2. It's your last quarter of semester nap. I don't mean to hate on it that much. I mean, we owe a lot to variance analysis. We owe a lot to this in terms of businesses. Standard costing and the traditional cost accounting, I want to give it one hoorah here before we attack it next chapter. Traditional cost accounting measures have been in place more or less for a century and have helped firms improve their profits and therefore make better and more cost-effective goods for you. And all this electronics, all this stuff, I'm looking around and seeing marvels of technology there on the desks and those that you have in your pockets and on your wristwatches and all that. All those have come about in large part because companies are economizing their quantity and price variances, or at least it plays a significant role. So these are things that are very useful for companies to have. I know some of it's a little drier, But ultimately, this is kind of the nuts and bolts of how I say, we were this profitable this period. How can we be more profitable next period? We've got to break it down into the individual components, pulling just one lever, et cetera, et cetera, et cetera. And we get these numbers. We can now talk to somebody about these numbers and see, hey, you did really well, favorable variance. How can you make decisions that'll improve things for next period? Or how can we take you, like Michael Scott, and go to the other branches and tell them how you did such a good job over there in Scranton? Or if it's really unfavorable, okay, well, how can we improve this? What kind of remediation can we do? What kind of resources do you need? What kind of training can we give you? What kind of people can we supply you with? Or is it past the point where you're useful to the company? Do we need to have you go somewhere else? Do all those kinds of things, and over time, that company can improve its cost makeup. All right, any particular style of 7-2 question you want to see for sure another example of? But the static budget isn't given. Okay, well, let's look real quick. A spending variance question. So we should have a static budget and actuals and compare them, but the static budget isn't given at all, huh? I wonder if I can find a question like that. What does it give you? Okay, look real quick.
Maybe I'm getting
No.
I was following off your list.
Okay. I wonder, let me try and find something just like that. So I think we're probably going to have to, it's designed to make us come up with the static budget amount and everything. We're going to tease it out. It's open answer, so it cannot be determined. That the Canvas doesn't do that with open answer, doesn't accept that. So this is asking for volume variance, but it is a very similar setup. Let's go ahead and we can be picky. Let's see if we can find a spinning variance, right?
Yeah.
Spinning variance. Yeah. All right, overhead volume, price. Let's give it at least two more times. Double check. Man, it's killing me. Oh, not that. Okay. Nope. Well, that's two open answer questions. Looks like every quiz here, sorting through the test bank here, and it's not. Really doesn't want to give me that kind of question. There we go. Okay. So yeah, if you noticed, the names on these open answer ones have a theme. I don't know. I was in a mood that day, I guess. What's a name for a company? Okay, I'll just use some random name. Great. What is the firm's fixed overhead spending variance? All right, so we know we're going to have to figure out actual cost and static budget cost and subtract them away from each other. Actuals minus static budget amount. We are given, in this version of the question, and there are multiple versions, this one gives us the actuals. Does yours give you the actuals? Just not the static budget. Okay. So we have the actuals here. We know we're going to have to subtract something from this $31,126 in actual overhead costs. Now, we're going to have to figure out the PDFOH from this stuff right here, basically. How much of our 1168 is due to fixed overhead costs, which in this case looks like 53% is due to variable. So the remaining 47% is due to fixed overhead. So we multiply this 1168. There, I'll do equals 1 minus 0.53, which is 47%. This is percent fixed, PDOH. We're going to multiply these two together, and we end up with this as our predetermined fixed overhead rate. We said earlier we have 31,126 as our actuals. Just didn't write it down. Now we have it down. All right, so now we have our standard price. Static budget is going to be the standard price times the standard quantity on the static budget. So the firm budgeted 2375 units of cost over consumption. So that's our standard quantity for this question. We're going to take it as simply as we can here. 2374. So we should have, this should be our static budget amount. Assuming I haven't misread the question I wrote here. No, that looks right to me. All right, so we can take the actuals and minus the static budget, and that should be our answer for this kind of question. Let's go paste it over. I can round it to cents. I don't think it counts me off if I just leave the number unrounded. In fact, let's double check that. Okay, so the questions will, on some of them, will have you do a couple steps back from the subtraction. Some of them were like this one right here, where it's just, okay, we'll identify the numbers and subtract them in accordance with the equation, whichever one I'm asking for, and figure out favorability. Others, okay, well, let's see if you can make sure you can put together all the pieces here, figure out what the PDOH decomposes into variable versus fixed components, and can calculate up. Some of them, I think some of them require you to multiply out to get the actuals, if I'm not mistaken. They are requiring you to multiply out to get the static budget here. Okay. All right, so that is an unfavorable variance, of course. We spent way more on fixed overhead than we budgeted, and I don't know why, but we can track that down. That's the beginning of an investigation. Let's go see why. $18,000 worth. Okay. Got another request? Particular type of question you want to see? Question 10 right here, this one. Thraw's strategic solutions. All right, so fixed overhead spending variance. It's same style of question. In fact, we can figure out both the variances. We'll try to figure out both the variances. Okay, let's see if we can do both, just for extra maximum effort here. All right, so Thraw's strategic solutions, a firm that uses predetermined overhead rate, a PDOH rate, to allocate overhead. The firm incurs variable and fixed costs. We have $15 per unit as our PDOH. 49% of that is for variable costs. Okay, so we have $15 PDOH. We have 0.49 as our variable component. Percent. I said percent fixed up above, and I said variable percent here, but whatever. So the remainder, 51%, needs to be it must be the fixed percent of our PDOH. So we're going to multiply that. That should be our predetermined fixed overhead rate. $15 times 51%, 7.65. Kind of surprised that's even. Oh well. Maybe I shouldn't be. Okay, so that's our standard price. In case we need that. We have actually incurred $29,100 actual fixed overhead costs, which is just up there. And we can multiply this by our budgeted to get the static budget. 2112 is our budgeted cost driver. So we would have budgeted, based on the predetermined overhead rate, our budgeted number of cost drivers. We were budgeting $16,156.8 in budget in fixed overhead costs. That's what I'm trying to say. static budget. That's our static budget. So for the spending variance, we can subtract these two away from each other. So that's our fixed overhead spending variance. Now let's see. We have our static budget amount now. And if we can figure out the applied amount, which I think we can now subtract the applied from the static budget amount, and then that'll give us our volume variance. Okay, just to be clear, this is the answer for this question. It should be. So we would have applied based on 1441 of actual cost driver consumptions. And so as a result, we would have taken that 7.65 PDFOH as the fixed component of our PDOH times the 1,441 units of cost driver actually consumed. We would have applied 11,000 something dollars in fixed overhead cost. So now we can take these two and subtract them away, and we get our volume variance. Yeah, fixed overhead volume variance is a different animal than typical volume variance because fixed overhead shouldn't be varying with volume. So the fact that it's varying, the fact that we put on the books 11,000 when we budgeted 16,000 back when we're looking at the actual fixed costs, that's a bad thing. That's not good. That's rather. Let me phrase it this way. That's creating more fiction. The fact that we applied cost this way compared to our fictitious static budget we came up with based on our best guesses at the time. This is not based on our best guesses at all. It's just based on the thoughtless mechanics of our overhead allocation system. Okay. Let's try that out. Let's see if we got just those two questions. Yeah, let's see if we get 5 points. Hopefully, cross fingers. Okay, good. All right, well, look, I think we should stop there. Wednesday, we'll come back, try some more 7-2, maybe start talking about some Chapter 8 stuff, see what happens. Try to go a little crazy.